The U.S. Federal Reserve has held interest rates steady but leaned more hawkish after Kevin Warsh's first policy meeting in charge of the central bank. Policymakers unanimously kept borrowing costs at a range of 3.5 to 3.75% for a fourth straight meeting, as widely expected. But the apparent unanimity among officials masks the delicate position that Mr. Warsh faces at the helm of the Fed. He was handpicked for the job by President Trump, who has waged a relentless pressure campaign on the central bank to cut rates. But Mr. Warsh is now presiding over a central bank that has shifted towards greater caution on inflation. Now, roughly half of the officials forecast one or more quarter-point rate hikes by the end of the year. 8 officials see rates remaining unchanged by year-end, and only one person penciled in a quarter-point cut. Mr. Warsh himself has declined to submit a projection.
You might have already noticed something, a difference in today's policy statement. It's a bit shorter, a bit simpler, and it dispenses with some older language. That statement just gives you the facts as best we can judge it. Absent also is so-called forward guidance, which we agreed was not well suited to the current policy conjuncture.
Well, the rate hike forecasts reflect heightened concerns that many officials harbor about the trajectory of inflation. The Fed has sharply raised its U.S. inflation forecast for the year to 3.6% from 2.7% in their March projection. Mr. Warsh has also set up 5 task forces. The panels will look at how the Fed approaches inflation, its communications, the use of economic data, as well as how it assesses productivity and the jobs market. Well, Treasury yields rose as investors reacted to several Fed officials penciling in a rate hike for this year. The 2-year yield, which more closely tracks the Fed's short-term policy, that one climbed to its highest in 16 months. The 10-year yield, meantime, which is a key benchmark for U.S. borrowing, also rose. And Wall Street fell as investors grew uncertain over the path of monetary policy and rising inflation concerns. And for more, we're joined by Krishna Guha, Senior Managing Director, Vice Chairman of Equities at Evercore ISI. Krishna, thank you for your time today. Just taking a look at Kevin Warsh, really emphasizing their price stability. And then markets took it to mean that the Fed likely would hike this year. I also note that, 9 officials expecting at least 1 quarter-point hike this year, although no forecast from the man himself. Any of this is a surprise to you?
I think it is a surprise that the overall message was as hawkish as it was. So we were expecting 5 or 6 Fed officials to pencil in a hike this year. That was actually pretty much the most that anyone in the market was expecting. But of course, we got 9 putting in a hike this year, the same number as put down policy on hold. So that part certainly was hawkish. But I think also the Warsh press conference came over as pretty hawkish. The new Fed chair doubled down again and again on the importance of the Fed committing to price stability, to delivering price stability. And in the absence of any nuanced guidance or discussion of their strategy or reaction function, the market not unreasonably took away the conclusion that the Fed is much closer to pulling the trigger under Kevin Warsh in one of the next few meetings than it thought. And really all now rests on whether the next few inflation prints will be cooler or not.
Yeah, so you say that, it's a surprise that the overall message was as hawkish as it was, and you're seeing Kevin Warsh double down. What do you think has shifted such that the Fed is now taking on such a hawkish stance that has come as a surprise to many?
So I think it's been the case for a while that there's been growing concern on the committee about inflation running once again above 3% likely all year, and meaningfully above 3%, even on the core PCE measure that excludes the direct effects of higher energy and food prices. And so that's left many officials really on a sort of borderline of whether they think it's going to be necessary to hike or not this year. What was interesting really is just the number who felt they're now just a little bit on the side of that line that says it's probably going to be appropriate to hike. Could be a little stale. It may not fully incorporate the implications of the US-Iran deal and the lower path for oil. But both the committee's overall assessment and Warsh's press conference make it clear that that's by no means the only issue in terms of the inflation and rates outlook. But I think, if anything, the biggest surprise was from Warsh himself. There was this debate going in. Would we get the old hawkish Warsh back from his days as a Fed governor under Bernanke, or the new, more dovish AI productivity Warsh who had auditioned for the job as Fed chair? It's not 1-0, but the flavor here was a bit more old Warsh than new Warsh.
Yeah. And on top of Warsh not also, submitting his own rate forecast, he kind of indicated that, of course, he's been skeptical of forward guidance. He's playing down the importance they have giving those press conferences after policy meetings, say central banks should not over-communicate its views. Does this represent a fundamental shift in how the Fed will communicate with markets from now on? And if the Fed does move away from this, and what does this mean for investor confidence and market stability? And for you, do you think that the Fed is due for an update in how it communicates?
So here I respectfully disagree with the position that the new Fed chair is taking. My view is closer to that of former Fed chair Bernanke. I believe that central bank communication is a powerful technology that contributes to the effectiveness of monetary policy making, and if done right, can minimize inefficiency and volatility in markets. Now, Warsh is absolutely right that a central bank should not communicate more certainty than it really has, in particular about the economic outlook, which is always uncertain. And it should very rarely give binding forward guidance, only in the most extreme conditions and with proper get-out clauses. But what we saw today was a Fed chair who wants to pull back from communication in a much broader sense. He refused to give any discussion of monetary policy strategy, any discussion about the reaction function. In other words, the way that the Fed intends to respond to different information that comes its way. I personally believe that's a retrograde step. In any event, it does promise more volatility and uncertainty for markets ahead.
Yeah, and I do want to ask you whether things could change in terms of the inflation picture and what the Fed could do up ahead, because, of course, we have that U.S.-Iran peace deal. And look, if that continues to hold, the agreement is signed as well. The Strait will soon be reopened. Does this materially change the Fed's policy trajectory in the coming months? Noting that this decision from the Fed came in just before that agreement was signed. And on top of that, whether the projections by the Fed on the inflation rising and growth slowing, how materially could that change as well, you think?
So they could change a bit. And that's part of the reason why it's probably still premature to think that the Fed is locking in for hikes at this juncture. But the Fed's analysis, our own work, Warsh's discussion, such as it was, of the inflation dynamic, I think underlines that there's a lot more going on here than just the oil shock from the US-Iran war. The US, of course, is still only just past the peak impact of tariffs on inflation. That should fall away in the coming months, but that's not guaranteed. And we have a further wave of AI cost spillover pressures into core consumer inflation that seems to only be building at this point. Now, that too might peak, say, around Q4, Q1, when new models of smartphones and laptops are announced, delivered with the price resets. That may well fall away some in 2027 as well. But it's a complex picture, and the underlying inflation rate, which we do think is sub 2.5% and tracking lower, still hasn't decisively come through in that cleaner manner. It does feel now that we're racing the clock, that we need the next few inflation prints to provide some reassurance, both at the aggregate level, but also in terms of those individual stories. Are tariffs rolling off? Is that pass-through from oil into core inflation looking like it's going to peak at lower levels and before then roll off? What's going on with AI capex cost spillovers? And are we seeing more clear evidence in the data of this downshift in the underlying inflation trajectory. If that doesn't come through, it feels to me at least like Warsh has boxed himself in, perhaps quite deliberately, to a position where if that doesn't happen, he's going to have to hike by September.
All right. Appreciate your time, your insights this morning. Krishna Guha, the Senior Managing Director, Vice Chairman of Equities at Evercore ISI.